Back to another video, another live. And today we're going to talk about the real reason why the market hasn't crashed. And we probably could say yet. Why the market hasn't crashed yet. Or will it? We're going to talk about that. But before we do, I want you guys to hit that like button for me. Extremely important that you hit the like button. The YouTube algorithm loves when you hit the like button. They will share this content with more people when you hit the like button. So do me a huge favor as you guys tap in. Please hit that like button for me. Let the YouTube algorithm know we rock with this channel, and we're showing you that we rock with this channel because we're smashing that like button. So please smash the like button. Extremely important, guys. Hit that like button. Also, if you want up to 12 free stocks from Webull, Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of this video. Click on that Webull link. Open up your new Webull account today. Go get that free stock. Go get that free money. Also, I'm going to send you a Webull tutorial video to walk you through how to use the Webull app to make your first trade. All you got to do is send me a DM on Instagram at RichardFain28. Let me know you opened the Webull account. You funded the Webull account. I'm going to go ahead and send you that Webull tutorial video as soon as you send me that DM. And that DM is going to be at Instagram at RichardFain28. So go on Instagram and DM me at RichardFain28. Once you do that, I'm going to go ahead ASAP. I'm going to send you that Webull tutorial video so you can get started immediately building wealth. Guys, I apologize. Got the lawnmower guy out here today, so I apologize about that little disruption. But you know how it is when you're making content outdoors, sometimes you have interruptions, but he's just doing his job, and I really appreciate him doing that because I don't want to get out there and cut the grass. So it's nice to have somebody that does it. But let's get into the main thing you guys come here to listen to. And that's really my opinion on why the market hasn't crashed yet. Now, in order to talk about that, we have to really understand, what makes up our market, right? In my opinion, you have the financial market, which includes what? In real estate, it includes paper assets. It includes, I believe it includes the job market, right? And then you got our economy, right? You got our economy, which in my opinion is also a part of our financial market. It's a part of our financial system. And what happens is in these markets, they go up and down, depending upon our economy. That's my opinion. I think our economy is the key to all of our markets, right? Specifically, if we talk about, let's start with the housing market, right? The real estate market. What's happening right now? Right now, interest rates are extremely high for residential 1 to 4 family dwellings. They're also extremely high for commercial real estate as well. And the commercial real estate market, you don't get a 30-year fixed rate, right? You get a 3-year fixed rate. You may get a 5-year fixed rate. If you're lucky and you're a good customer of your bank, you might get a 7-year fixed rate. The concern with the commercial real estate market is a lot of their loans are getting ready to mature. A lot of their loans are getting ready to come due. And when they come due, that means that 3-year interest rate or that 5-year interest rate is done. And if you want your bank or your lender to renew your commercial loan, you're going to have to renew it at a higher rate because rates are higher today, right? 3 years ago, that rate doesn't exist anymore. It's probably double what it was 3 years ago. So if I'm a commercial client and I have a commercial loan, commercial real estate loan coming due, and I'm currently locked in at 3%, it probably won't renew at 3%. It's going to renew somewhere in that 7 to 7.5% range. That's a concern in the commercial real estate world. Why? Because of cash flow. When I double my interest rate by 3.5%, in addition to what I used to have, the cash flow doesn't make sense. And if the cash flow doesn't make sense, then guess what? Most of these commercial real estate owners are going to try to find a way to get out of this property. Problem is, they ain't going to have any buyers because no one wants to go out and get a loan at 7.5% to buy your property. So there may be some defaults. That's a problem for our real estate market, especially our commercial real estate market. There may be some defaults coming associated with commercial real estate owners not being able to finance their properties at an interest rate that doesn't strangle their cash flow. So that's a problem. Why is it a problem in the residential real estate world? Well, it's a problem in the residential real estate world because of what? Interest rates again. A year and a half ago, I could get a 30-year fixed rate mortgage at 3%. I can't do that anymore. You guys understand, about a month ago, actually in September, 30-year fixed rate mortgage rates got up to 8%. And right now they're hovering around 7.5%. So what does that mean? That means, guys, our housing market is in trouble, right? If we don't have people that can actually afford to buy real estate, then what good is that going to do us, right? It's not going to do our housing. I apologize, guys. I have to come back in the house. Lawnmower guy's getting to be a little bit too much for me. But my thing is what's the worst thing that can happen to the residential housing market? Nobody buying real estate. That's the worst thing that can happen. And that's what's happening right now. No one's buying real estate. Why? Because it's too expensive. Most Americans can't afford a mortgage payment that is based on an 8% rate. They can't afford it, right? They can't afford it. I'll give you a quick little illustration of what I'm talking about. Let's say you got a $500,000 loan request, right? From a new prospective homeowner. They're saying, hey, we found a beautiful house. We need a $500,000 loan. Now, a year and a half, 18 months ago, you could have gotten that for 3%, right? You could have got that $500,000 loan to buy your new house, and your interest rate would have been 3% fixed for 30 years. That payment would have came to $2,100. Okay, we can afford that. We got approved for that. But for whatever reason, you didn't pull the trigger. 20 months later, you go back to that same community, you go back to that same house, and you say, hey, we're gonna try this again. Problem is, you go to your local bank and you say, hey, we want this $500,000 house. I know we didn't pull the trigger 18 months ago. Some things came up, we couldn't pull it off. But right now we wanna try it again. Problem is, you're gonna be at an 8%, 7.5%, 8%. And if you're at an 8% interest rate on that same $500,000 loan, guess how much the payment is now? $3,700. $2,100 18 months ago at 3%. Now it's $3,700 right now because of an 8% interest rate. See, that's affordability issue, guys. That's a problem for our housing market. It's a problem because people cannot afford to buy. So yes, the commercial real estate market is in trouble because of what? Interest rates. The residential or housing market is in trouble because of interest rates as well, right? One is an affordability issue where Americans can't buy new homes because they just can't afford the monthly payment. The other is commercial real estate owners are not going to be able to afford to pay the interest on their commercial real estate loans at 7.5 or 8%. They're just not. Why? Because normally with commercial real estate, you lock in tenants to like 5-year lease agreements, maybe sometimes 7-year lease agreements. If you're smart, you lock your tenant into the same, you lock your tenant into a lease agreement that coincides with what? Your loan agreement, your loan interest rate. So if I got a 5-year fixed rate from my bank, right, I should be signing my tenants to 5-year leases so that when my loan comes due and my interest rate potentially could go up, I can increase my rental rate to my tenant. So I want my lease agreement and my loan fixed rate contract to be the same, right? That way I'm able to increase my rental income if my interest rate goes up. So hopefully if you're a smart commercial real estate owner, that's what you did. If you were not, and you've locked your people into 10-year lease agreements, and now all of a sudden your loan is coming due and your interest rate's getting ready to go up, but you can't raise the rent on your tenant because you locked them into 10-year leases, then you're gonna be in trouble. And some real estate owners are in that predicament. So yes, our real estate market could be in trouble, right? It could be in trouble. Now let's move on to the stock market. Will the stock market crash? Now, again, guys, all of this is just my opinion. You certainly have a right to go out and do your own homework and figure this thing out for yourself, but I'm giving you my opinion, what's going on. So if we look at the stock market, let's look at the S&P 500. Let's start with that. The S&P 500, right, year to date, ROI is around 13%. Pretty dang on good, right? Yeah, you would say pretty good. Doesn't seem like a crash is nowhere to be found in the stock market, right? At least that's where it looks on the surface, right? You say 13% year to date on the broader stock market, which is the S&P 500, is pretty dang on good. But look at it this way. When you take the top 7 companies, right? The top 7 companies represented in the S&P 500 have a 28% share. They, on a weighted average, they're 28% of the S&P 500. 7 companies, guys. 7 companies. What are those 7 companies? Apple, Amazon, Alphabet or Google, NVIDIA. That's 4, right? Meta is 5. Microsoft is 6. And then Tesla is 7. Those 7 companies make up 28% of the S&P 500. Pull those 7 companies out of the S&P 500, guys. If you pull them out of the S&P 500, and you have the other 493 companies remaining, you do not have a 13% year-to-date ROI. Nowhere close, right? You take those 7 companies and you look at what they've done year-to-date, 92% return. So there's an argument that the S&P 500 is not as strong as we think it is if you were to take those 7 companies out. Or better yet, if those 7 companies were not to do well, right? So when you think about the stock market, you got to think about the broader stock market. And typically, most people think about the broader stock market in context with the S&P 500. My point is, if you take those top 7 companies out of the S&P 500, it's not looking as good as we thought. Or if those 7 companies perform poorly. What is another thing those 7 companies have in common? What do those 7 companies have in common that I just mentioned that represent 28% of the S&P 500? What do they have in common? They're all tech companies. They're all tech companies. So if the tech industry at any point, guys, takes a nosedive, there's a really, 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 really good chance that those 7 companies that represent 28% of the S&P 500 could nosedive as well, if the tech industry as a whole nosedived. I'm not saying that's going to happen. I just want you to think. I just want you to think and understand what really makes up the stock market, right? What really makes up the S&P 500? I'm a huge proponent of the S&P 500. Made a lot of money in the S&P 500, right? And I continue to dollar cost average into the S&P 500. But I also need to understand, where are the vulnerable points of S&P 500? What could potentially be a risk to me and my money when I'm putting it in the S&P? That's why I'm telling you, some people are saying it's not far-fetched that the market could repeat itself like it did in March of 2020, right? Because when you think about really what's happening, you pull those 7 companies out of the S&P, it's not doing as well as we think it's doing. Or if those 7 companies perform poorly, if the tech industry performs poorly. Now, when you look at those 7 companies, right? The top 2 companies that represents the biggest percentage of the S&P is going to be Apple and Microsoft. So Apple represents about 7% of the S&P 500. That's a big percentage, guys. Microsoft is 7%. So you got 14% of the S&P 500 when it comes to the weighted average. 14% is represented by Apple and Microsoft. Tesla represents about 2%, right? So you got 7 companies, man, 28%. And then of that 28%, you got 2 companies that represent 14%. That's interesting, man. Good news is Apple is what? The most valuable company in America. Actually in the world, right? Not just America, the world, right? So those 7 companies, although a little concentrated, if you ask me, because you got 493 other companies that represent the other, 72%. But when you just pull out those other 493 companies, they don't have a 13%. No, not even close, right? Not even close. So really the tech industry, like I've been telling you guys, that's why when I'm out buying ETFs, I like tech ETFs. Because the tech industry, as you can see, in the broader stock market is really driving the S&P 500. And that's not a bad thing. You just need to understand what's driving it, right? You got to understand what's driving it. And I just gave you the information. All you got to do is go out there and fact check it, do your homework. But those are the 7 companies that are driving the S&P 500 to hit the ROI it's hitting year to date. And like I said, you take those 7 companies out and you just look at their ROI as a group of 7, they got about a 92% return. So you can look at it bad, you can look at it good. Personally, I look at it as good because I think tech is the future anyways. So I got no problem with Tesla, NVIDIA, Alphabet, Meta. I got no problem with that. Apple, Microsoft. I got no problem with those 7 companies being really, toting the rock, as we would say it from old sports guy in football, toting the rock. I don't have a problem with them really being really the safety net for the S&P 500. I don't. I just need to know that they're the safety net. So therefore, I know when I'm looking at those 7 companies, and I'm looking at their quarterly earnings reports, I can go to those 7 companies and say, well, okay, how are these 7 companies doing? Because if these 7 companies are not doing well, the S&P 500 is not going to do well. If these companies are doing well, guess what? I'm good. I'm going to continue dollar cost averaging to the S&P 500 because I know they represent 28% of the S&P 500. They are really the safety net for the S&P 500, those 7 companies. So you just got to know. So right now, no, I don't believe the stock market is in trouble. I think the real estate market, in my opinion, from an interest rate standpoint, is in more trouble than the stock market. That's what I believe. Now, one more thing about the stock market. Who is the largest company in the world? Who is the largest company in the world? And I know some of you guys are going to say Apple. But that's not correct. The largest company in the world is the United States, right? The United States is the largest company in the world. We have $33 trillion in debt, guys. And our interest payments on that $33 trillion in debt is humongous. Why do I mention that? Because you guys got to understand, with the United States being the largest company in the world, you got to understand that if the interest rate on that $33 trillion in debt goes up by 1%, guess what happens to the interest payments on that $33 trillion in debt? The interest payments go up by $320 billion per year, with 1% increase in interest rate on that $33 trillion in debt. I would be more concerned about that than the S&P 500, right? For our markets, I would be more concerned about the U.S. debt, $33 trillion and climbing. I'd be more worried about the $1 trillion in credit card debt that we currently have in America. I'd be more concerned about that than the stock market crashing. Because so here's the problem. With $1 trillion in credit card debt, guys, with an average interest rate of around 22% on that debt, I'm going to tell you something. That's not sustainable, right? It's not sustainable. Here's another one for you. $1.6 trillion in this particular type of debt. And guess what? About 40 million Americans have it. What am I talking about? Student loan debt. That's right. We have $1.6 trillion in student loan debt, and about 40 million plus Americans have a part of that student loan debt. Just turned the interest payments back on in October, this month. Interest payments just got turned back on. So when you're talking about a crash in our markets, you have to take in consideration everything, the whole picture. You got to think about America and its debt at $33 trillion. Every 1% increase in the interest rate to service that debt creates an additional $320 billion a year in additional interest America has to pay. When you think about the American people and their relationship with credit, it's pretty raggedy, especially with credit card debt. It's pretty raggedy. Over $1.2 trillion in credit card debt. Highest it's ever been, guys. At an average of 22% interest rates. I would be terrified if I was somebody that had any credit card debt at that type of interest rate. And then, of course, the cherry on top of the ice cream sundae, student loan debt. Guess what? Government turned back on the interest rate. They want to get paid back. Oh, they're going to forgive the 1 point. No, they're not. They're not going to forgive anything. They already got 33. This is also what I wanted to get you guys to understand. Who owns that corporation? Who owns the largest corporation in the world? And I've already told you, the United States is the largest corporation in the world, right? Who owns it? You and I own it. We own it. Who pays the interest on that 33 trillion, or at least a part of it? We do, through our taxes. Here's the problem though. The taxes that the United States government collects is not enough to run the country. It's not enough. That's the reason why we got $33 trillion in debt. Because the tax that the US government collects from us, the citizens, is not enough to run our country, guys. That's the reason we got $33 trillion in debt, right? It's not enough. Now, the good news for us, or for our corporation, is that we're the world's reserve currency. So all we got to do, we just print more money. We just print more money, right? We'll print it because we can. We have the world's currency, right? Everybody transacts their business in the US currency. Yeah, there are some countries that say they're going to create their own. The world currency is the US currency, the dollar, right? So even though we got $33 trillion, guess what? We'll never pay it off. Our system is set up not to pay it off. It'll continue to escalate, right? It's not set up to pay it off. Well, when are they going to pay off that $33 trillion? Never. It's not set up to pay it off, right? As long as we're the reserve currency, as long as the dollar is the gold standard, basically, right? We're not going to pay it off. We have no intention of paying it off. You just have to understand that. You have to understand the U.S. economy is the #1 economy in the world. It's the largest corporation in the world. The U.S. dollar is the reserve currency for the world. So I don't think we're in trouble from that standpoint, even though I know a lot of people try to act like we are. We're not. As long as we're the #1 corporation in the world, long as our dollar is the reserve currency for the world, we're going to be okay. Our financial system is not set up to pay off that $33 trillion. It's not. But that's why when I look at a lot of people in America's finances and they have a bunch of debt and can't pay it off, it's no different than the US government. We got a bunch of debt that we can't pay off. But yet and still, we still function as a country. We still are the reserve currency for the world. Our dollar is still the reserve currency. So in that standpoint, we're just doing what we've been taught to do. Like I told you, that programming, right? We've been taught to always have debt, right? Always have debt, which in my opinion is really, really a lie. You shouldn't always have debt, right? You should get to a point where you don't have debt, right? You should get to a point where you're financially free. But I don't want you guys to be fearful of the markets crashing. I've told you, in my opinion, what's happening. Now let's talk about real quickly the labor market. That's part of our market as well. That's part of our economy. You know, will there be a crash in the labor market? Well, here's the deal, guys. You got a lot of corporations out there, big Fortune 500 corporations that have a lot of debt out there, and that debt has an interest rate fixed to it. And those interest rates are going to be resetting. I'm talking about a lot of corporate debt, like Fortune 500 corporate debt. I think in 2023, it was about, I want to say, 300 or 400 billion that was set, the interest rates were set to reset. I think in 2024, it's even worse. I think it doubles in 2024, like 800 billion, or it might be even close to 1 trillion of corporate debt. That's interest rates are getting ready to reset. And that is scary for a bunch of CEOs. If you go out and start doing some research on this, you'll know 84% of big Fortune 500 company CEOs think there'll be a recession. Like 84% of them believe there will be a recession. Why do they believe that? Well, they believe that because of this corporate debt. This corporate debt that's getting ready to reset. Interest rates are getting ready to reset. And when those interest rates reset, they're not going to reset at this really low interest rate that where they're at today. Nah, they're going to reset higher than that. And a lot of corporations are not going to be able to service the debt. And some of them, the only way they will be able to service the debt is they're going to have to do what? They're going to cut expenses. And I've already told you guys, when big corporations have to cut expenses, the first place they go is where? Employees. That's the first where they start, because that's their biggest expense. Most corporations' biggest expense is their overhead associated with their employees. Payroll, benefits, that's the biggest expense. So if I'm a big Fortune 500 company and I gotta go cut expenses because my interest rate doubled on my debt, where do I start with? I start with my employees. That's where they start. They're gonna start with their employees. They're gonna cut employees. They're gonna have to cut expenses, and that's where they start. And how does that affect the labor market? Potentially, unemployment rate could go up. People get fired, unemployment rate goes up, which does what? It affects the labor market. So the labor market could experience some turmoil. It could experience a crash if this corporate debt goes up high enough and these corporations can't service that debt. You got to understand, I told y'all, these corporations, for the most part, they borrow money to grow. Everybody doesn't have Apple's balance sheet where they're just flushed with cash. Most of these companies are not flush with cash. They have to borrow money, right? They borrow money, they take that cheap money and they invest it into growth. A lot of them do this as well. They borrow money at 3%, and then they turn around and go get a U.S. Treasury with a nice 2 to 3% spread on it, and they just let the money sit and they earn interest on that too. But the majority of them use the money for growth, right? And when it's cheap, it makes sense, because if I can borrow at 3% and I can turn around and invest it in growth and get an 8% return on the growth, but I borrowed the money at 3%, it don't take a rocket scientist to figure out, or a PhD in mathematics to figure out, I can make money that way. But when I gotta borrow the money at 6% or 7% or 8%, it don't make sense anymore. So I gotta cut my expenses, and that could mean people losing their jobs, because for most companies, payroll and benefits is the biggest expense, right? It's not the buildings, it's not the private jets, it's the payroll, it's the benefits. So when companies get into trouble, that's the first thing they turn to. Oh, I gotta lay off 1,000 people. Oh, we gotta lay off 10,000 people. Just the way it is, right? So keep an eye out on this corporate debt that's starting to reset. Interest rates are starting to reset. 2023, 2024, 2025. I think in 2025, it's like $1.3, $1.4 trillion in corporate debt that's going to reset. Also, I was looking at one interesting statistic where when the Fed, over history, when the Fed has increased interest rates like they did, right? You got to understand, from 2022 to 2023, the Fed increased the short-term interest rate, I believe, by 4.48% or 4.5%, which is one of the fastest pace in history, right? But typically when they increase that fast and when they stop increasing, when they stop increasing, they just put a pause on it, no more increases. Normally, on average, typically about 11 months after that, on average, a recession hits. That's what statistics have said, and that's what history has said. Now, will that happen this time? I don't know. I thought that was interesting, though. So after they stop rate hike and they just pause it, on average, So that means if history is correct, let's say the Fed bump one more time in November, right? Let's say they bump in November and then they stop. You're talking about a year from November, tail end of October, early November, there could be a recession. What else is happening in a year? Elections. We're going to be in the middle of electing a new president. I don't know, man. Those two things are a little too close for me. You're going to be in the middle of an election, a presidential election, and history says you could be going into a recession. I don't know, man. Again, guys, I'm not telling you we're going to have a recession. I'm just telling you what history says, what's out there. See, I get out there and I listen and read and try to comprehend what's happening in our economy, what's happening in our markets, so that I am putting myself in a better position to be able to do what? Invest effectively, right? So that I can get to more wealth, build more wealth. And that's what you should be doing, right? Now, in my opinion, no matter what happens, if we do have a crash in the markets, I still look at that as an opportunity to build wealth, especially if I'm in the building stage of wealth. I don't look at that as, oh, golly, I'm going to lose it all. I don't look at it that way. I look at it as an opportunity to pick up discounts of really, really good companies, really, really good ETFs. I look at it as an opportunity to pick up really good real estate. If the real estate market does crash and it experiences a decline in property values, prices come down, which I don't believe it will, but if it does, I'll do just like I did in 2008. I'll just pick up really good properties and I'll hold them, just like I did in 2008. I want to give you two quick stories about the stock market and how I built some wealth, and then we're going to wrap this thing up. So in 2012, I changed jobs. I was still in the banking industry, but I left one bank and I went to a smaller bank, right? I went from a large national bank to a regional / community bank. And when I did that, I got to this new bank, and they said, hey, man, do you want to participate in the 401k program? And of course, me being a savvy investor at that point, I was like, absolutely. If you guys are going to give me a free match, yes, I'm all in. Tell me what I need to do. So I decided to jump into the 401k. Now, you got to understand, I'm brand new at this little community / regional bank. Still making great money, still making 6 figures a year, but wanted to get out of the national banking business and get into the more regional community banking business. So I made the transition. So I started putting 10% of my money that I would make pre-tax dollars, 10%. Got to understand, I started at zero, guys. I started at zero. I started putting 10% of my pre-tax dollars into this 401k. But I wasn't just putting it into any old thing. By then, I understood, look, I'm looking for equities. I'm looking for growth. I'm not looking for bonds. I'm not looking for a hybrid. I'm looking for 100% equities, because I know in 7 years or so, I can really make this happen. I can make some really good money. So what I did was I started taking that 10% and I started putting it in that 401k program. And I believe at the time it was administered by, I can't remember who it was administered by, but I had the choice to go in there and pick the options of what I wanted to put the money in. And of course, I put it in equities, growth equities, right? Anything that was close to the S&P 500, anything that mirrored the S&P 500, that's what I wanted to put my money in. I put 100% of it in that, right? 10%, remember, 10%, that's all I did. No more, no less. And that probably represented, it probably represented about $15,000 a year or something like that. Because I think at the time I was making, like I said, I was making good money, and it was about 15% a year, right? About 15%, or maybe like $15,000, not 15%, 10%, but it represented about $15,000 a year. And I just did that, guys, for 7 years. Because I left that bank, I quit in December of 2019. I just quit because I was getting ready to go do this YouTube thing full time. But in that 7 years, guys, from zero, it went to $250,000, $250,000 from zero in August of 2012 to December of 2019. It went from zero to $250,000. Why did that happen? It happened because I did what? I took 10% of my pre-tax dollars and I put it in something that I believe would grow it. And it did. Right? It did. So my point to you is, I didn't worry about if the stock market was crashing. I didn't worry about that. All I knew was, if I can put this money into proven, historically proven investments that multiply money, it will multiply it if I do it long enough. And in those 7 years, that's what I did. I didn't worry about the fluctuations in the market. Now, a lot of people will argue, oh, it was easy because we were in a bull market. Well, you can say whatever you want to say. My point is, if you trust, not even trust, if you have a certain level of risk tolerance, if you have a certain level of risk tolerance, you can make money in the stock market. It's proven. People hold their money in the stock market, or they make their money in the stock market. That's one of the asset classes that people multiply money in. And that's what I did from 2012 to 2019. 7 years, guys. 10% of my pre-tax dollars, which was about $15,000 a year. And I just did that for 7 years. And next thing I knew, when I was leaving that bank, I had over $250,000 in just that one 401k account. You got to understand, I was in banking for 25 years, so I had several of these 401k accounts at every bank that I worked at. Now, so when I left banking, I did what? I took all of those dollars and I rolled them over into Vanguard. And I continued the process of growing that money. That same $250K I rolled over into Vanguard. And then in 2020, September of 2020, I took that same $250K that I rolled over from that last bank, and I invested it in what? Vanguard Information Technology, VGT. I put the $250K in there, and I left it in there for 3 years. When I sold it, which was in August of 2023, I think it was August. It was in September, maybe September. Maybe it's September. It was August or September I sold it. But when I did sell it, I made $100,000 in 3 years. All I did was, guys, let's go back to the beginning. In 2012, August of 2012, I started a 401k at a new bank I worked for. I took 10% of my pre-tax earnings and I funded that account every single month. It grew from zero all the way to $250,000 in 7 years. Nothing I did was just be patient, be consistent, and be disciplined, right? Dollar cost average. That's all I did every single month. Automatically out of my pre-tax dollars, boom, they would fund it. And I did go into the investment options and I put it into the most aggressive growth fund that they had that mirrored the S&P 500, because I knew I want to invest in big boy equity companies because that's where the growth is. I don't want no bonds. I don't want any of that stuff right now because I'm trying to grow my wealth. When I already grown my wealth and I'm ready to take income off my wealth, I'll transition it out of equities and I'll transition it into something like bonds, a portion of it, right? But not for now, not while I'm growing it. I want it all in equities. 7 years later, it was $250K. I left that job, got out of banking, went into my own thing. And I said, this is one, matter of fact, I rolled two of my 401ks over to Vanguard, but I didn't put them all together. That one for $250, I separated it from another one, right? I separated it. And then I had a couple more that I just left where they were because they were perfectly placed. But that one for $250, I invested in the VGT, Vanguard I'm sorry, Vanguard Information Technology VGT, which is a tech ETF. I put the 250 in September of 2020. In August of 2023, I sold it. And in 3 years, made 100 grand. So I went from zero, basically 10 years ago, I went from zero to a $350,000 upside, right? $350,000, zero to $350,000 doing what? 10 years of what? Just consistently investing. And you got to understand, for the last three of those 10 years, I didn't make any more contributions. Once I rolled the money over to Vanguard, I didn't make any more contributions. The only contributions I made were from 2012 to 2019. From 2020 to 2023, I made no contributions. And it went from 250 to 350 plus. Now the money sits in a money market account over at Vanguard, making 5.27%, ready for its next deployment. The reason I tell you that is, guys, is because I didn't do anything special. I did exactly what I'm asking you guys to consider. See, you don't have to always just try to hit home runs right out the, they just brought you up from the minors. You get up there at first bat, you trying to go for the fence. No, all you want to really do when they bring you up from the minors, you just want to get a hit to get on base. I just want to get on base. And I just kept getting on base. I wasn't trying to hit home runs. All I'm telling you guys, in a 10-year period, you can do that or better. But you got to be, you have to have a certain level of risk tolerance, right? You got to have a certain level of, okay, I'm comfortable with that. See, I was comfortable with that. Some of y'all ain't comfortable with that yet. But until you get comfortable, it's going to be hard to build wealth in the market. Don't worry about what all these people are saying. I know earlier in the video, I spouted off a lot of statistics, a lot of numbers. The bottom line is, if the market does crash, for you folks out there who are in the building stage of wealth, it'll be a gold mine for you. It was for me. That's why I tell you guys, I don't worry about when the market's, I don't worry about it. Because my thing is, if we do experience some type of downturn in the real estate market or the stock market, I'm going to capitalize on it, period. I'm going to capitalize on it. So I don't worry about it, because I know I know how this thing works. The way it works is you gotta buy assets at a discount, and then you hold those assets until they trade at a premium. That's all I did with that last 401k example, guys. I bought those investments for 7 years through dollar cost averaging, in my opinion, at a discount. And I continue to invest that money in 2020 to 2023 at a discount. And as soon as it got to a premium that I was happy with, I exited. And I made, right? Now, if you look at the real dollars I put in, what is it, 15,000 times 7? Somebody do the math on that. I'm not really good at math, but I would think that's what, 135, something like that? 130, 120, something like that. So my real investment was $15,000, pre-tax dollars, times 7. So that's the money I actually put in myself, right? And from that investment, I'm gonna call it 130. You guys correct me if I'm wrong, but because I'm not real good with just calculating this stuff in my brain. But let's say I put in 135. Let's say it was 135. It's worth 350 now, right? It's okay. I got somebody that just chimed in. I put in 105. Yep, 15 times 7, 105. That was the money that I put in pre-tax. It's worth 350. So, yeah, 245K. That's the growth that I've received in a 10-year period. $245,000 in growth when I exited that investment. I put in 105, it's worth 350 now. That's $245,000 of growth in 10 years. Who ain't gonna take that? But that's the power of doing what? Discipline, consistency, patience, and the right investments. See, you can't go wrong. In my opinion, you can't go wrong if you track the S&P 500. You can't go wrong, guys. So whatever investments you're in right now, you better look at them, especially if you're in the building stage of wealth. If they're not tracking the S&P, or if they're not giving you a return equal to or greater than the S&P, I would consider rethinking that strategy. I've already told you about the S&P, and the people go, oh, I don't want to go there because the 7 top companies represent 28% of it. What if they go bankrupt? Well, they ain't went bankrupt yet. I don't think Apple's going bankrupt. I don't think Microsoft is going bankrupt. I don't think so. I don't think Alphabet, which is Google, YouTube, I don't think they're going bankrupt. No, I don't think so. Maybe they have a downturn a little bit, but they ain't going bankrupt. And if they do, guess what? Perfect. Please have a downturn. So I can buy a bunch of y'all and just wait another 5-7 years till you get back to a premium, and boom, I make money again. That's why I keep telling y'all, you got to stop being so short term. You got to think long term. You got to be disciplined and think long term. That's all I did, guys, in that last example I gave you. Right? I thought long term. I said, okay, it's zero today, but if I put this 15,000 in over the course of the next 7 years with the growth I believe I'm going to experience, this is how you build wealth. I keep telling you guys that. This is how you build wealth. So please consider that. Don't worry about, oh, the market's going to crash. Don't worry about that. That's all propaganda. That's all propaganda. Does the market really ever crash? Let's be honest. No. It will go down in value temporarily, but it's temporary. See, crash means crash and never comes back. That's the way I look at crash. When somebody talk about crash, I'm talking about it crashes, but there's no recovery. It's done. That's a crash. What happens in the stock market is not a crash. What happens in the real estate market is not a crash. They have a temporary decline in value. And the key word is temporary. And if you're smart, you welcome that temporary decline, because that's when you buy. That's when you buy heavy, especially if it's big boy blue chip companies that you know are going to recover at some point. How do you know if real estate's going to recover? Well, buy in locations that people have a desire to live. That's all you got to do with real estate, man. I keep telling y'all, it ain't hard, man. You just buy in locations that people have a desire to live. And if that market declines in value by 20% or 30%, even better. Even better. Because when it bounces back, it's still going to be a place where people desire to live. Even when it declines, it's still going to be a place where people desire to live. That's what I keep telling y'all. Real estate is not hard. We make it hard. We try to make it complicated. Well, I don't know if I'm going to do the Burr method, or I'm going to do the XYZ method, or I'm going to do the 1, 2, 3, 4, 5 method. Who cares about all that crap? All I care about is give me a location, a residential location where people desire to live, and I will give you a winner. That's been my experience for 25 years. Every location that I bought a piece of real estate in has won. Why? Because the first thing I ask myself is, would you live there, Richard? And if the answer is no, I don't buy it. If the answer is yes, I buy it. And I haven't missed. Have I had a temporary decline in value on my properties? Absolutely. But guess what I did? I just held them. I kept tenants in them. I held them. I kept getting my cash flow. And then at some point, they increased in value again. And that's when I sold them. And I made a bunch of money on the appreciation. That's where the wealth is, guys, especially for small investors like us when we're doing, 1 to 4 family dwellings. And that's what I considered myself. I was a small investor doing 1 to 4 family dwellings. The only way you make money in that type of business is you got to buy properties, put tenants in them, and then you got to watch that property appreciate in value. I told you guys a story. I did that. I'd never owned more than 10 properties at one time. But what I would do is I'd buy a property every 2 years and put a tenant in it. And I started with zero net worth, and I built that portfolio to over $1 million worth of net worth. Just doing that. Buying one at a time, good neighborhoods where people have a desire to live. Not rich neighborhoods, not beachfront property, not all that. No, I just bought in good white collar / blue collar neighborhoods where people had a desire to live. It had good schools. decent amenities around the community where people could get out and walk and take hikes and things like that. The most important thing was it was low crime rate. People don't want to live in places where there's a lot of crime, guys. So if you're buying real estate in crime-ridden locations, I don't know, not for small investors. Now, if you're buying a 100-unit apartment complex in an area that you're going to Section 8 the whole thing, that might work. But for small investors doing one property at a time, 2 properties, no more than, that ain't gonna work. That's just gonna drive you crazy. So for me, I didn't want to be in high crime written areas. I want to be low crime, good schools, good, decent people living in those homes where people had a desire to live. And that's all I did. And I built a lot of wealth in real estate just doing that. That was not hard. Wasn't hard. Just like the example I gave you with the stock market, wasn't hard. But you do got to have a level of risk tolerance. You got to be able to say, well, okay, I understand there will be fluctuations in the market while I hold this money in there. But that's okay. I know history tells me if I just stay in long enough, there's a pot of gold at the end of the rainbow. That's my advice to you. Don't worry about if the markets are going to crash. Don't worry about what these people are out here saying. The 1% use all of these scare tactics to control you. They want to control you. And they use a lot of these scare tactics to do it. All along, this is where they hold their money at, or they make their money in the real estate market and in the stock market. That's where they make their money or they hold their money. But they want to scare you so they can manipulate you. Don't let them manipulate you. Don't let them do it. Right? Get your game plan together and stick to that game plan. When you got to pivot, pivot. Right? But you better have a game plan. Like I said, whether the market temporarily declines in value or not, be ready. There is no crash. It never is a crash. It's just a temporary decline in value. That's all it is. And that's an opportunity for you to build wealth when you see that temporary decline in value. It's not the time to run for the hills. Ooh, my portfolio went down by 15%. I'm going to take everything out before I lose it all. That's manipulation by the 1%, right? Now, if you're a person that's in the building stage, if you're a person that's in the enjoyment stage of wealth and you've already built your wealth and you want to take it out the market temporarily, then take it out. You've already built your wealth. You don't want to lose it. You've already built it. So take it out if you want to. I don't have a problem with that. That's the reason why, guess what? I exited that last example that I told you guys that I exited. Because some people are, well, why did you take it out? Because it's $350,000 worth of wealth. I ain't greedy. I got my money I needed to get. I went from 0 to 350,000. I made a $245,000 upside return on that. Why would I want to jeopardize that getting greedy? No, I exited, put it to the sideline for a little bit. I'm making a 5.27% interest rate monthly on it. So I'm making about $1,600 a month while it sits there until I deploy it to its next opportunity. So you got to be smart, guys, when you're investing. You don't just blindly just disregard it. But if you've hit the target you set to hit with that investment, exit it and wait for the next one. But if you have not hit the target, leave it in there. Because people ask me all the time, well, when is it the right time to sell? You sell when you hit your investment target. You should have a target. See, I had a target. And I hit my target, so I exited. Now, I got other money that I got still in the stock market that's still growing, doing different things. That's not the only chunk of money I have. That was just one example I gave you. But I got many examples like that where I got money deployed. I got another investment in Tesla, a long-term investment right now in Tesla. And guess what that thing doing? It's just up and down. One day it's in the green, one day it's in the red. But I don't let that deter me. Why don't I let that deter me? Because it's a 10-year investment. See, I got my time horizon. I know exactly what I'm trying to get accomplished with that investment before I exit it. So I don't worry about the ups and downs in it because I know long-term, I believe in 10 years, I'm going to triple or quadruple that investment in Tesla. That's what I believe. That doesn't mean it's going to happen, but that's my strategy. So Yeah, you just got to figure out what your strategy is, what you're trying to get accomplished, when you need to exit. You exit when you hit your financial goal. Plain and simple. If I start at zero and I want to get to 100 grand in a particular investment, once I get to the 100 grand, I exit. That's it. I don't, well, I'm going to get greedy and try to go 400. No, I don't do that. Now, if you want to do it, that's on you. That's not my strategy. My strategy is never to get greedy. Because see, when I get greedy, I make mistakes. When I get greedy, I make mistakes, and you get burned when you make mistakes in the market. So I don't get greedy. I just take my winnings and I'm going to the next one, right? See, this is not a sprint. It's a marathon. So don't be out here getting greedy, man. I'm telling you, get greedy, you're going to get burned. So don't get greedy. Set your goal. Okay, I'm going to take this $1,500 a month. I'm going to invest it in the S&P 500 or something that tracks the S&P 500 or something that tracks the total stock market, right? Or something that tracks a sector that I really like. I'm going to put $1,500 a month in it. I'm going to put $1,000 a month in it. I'm going to put $500 a month in it. I'm going to put $100 a month in it, and I'm going to do that for the next 3 years. Or until my investment gets to X, whichever comes first. That's what you do. See, then you know, okay, I'm doing it. So when you see the ups and downs, you don't worry about it. Oh, I ain't gonna worry about that because I got a 3-year hold on this. I know the history tells me this investment has a really good 3-year return. I'm just gonna sit tight and wait. Right? That's not me taking the $500 or the $1,000 or the $1,500 a month and just putting it in one stock. No, I wouldn't do that. I would put it in the broader stock market through tracking the S&P, tracking the total stock market, or tracking an index. Or tracking a sector. That's what I would do. I would not try to play that game with individual stocks because you concentrate yourself. See, I wouldn't do that with just individual stocks. The only reason I got the Tesla play is because it doesn't represent that big of a percentage of my overall portfolio. It probably represents about 5% of my total portfolio. So I took 5% of my total dollars that I had to invest and I put them in Tesla. That's the only concentration I got. Everything else is diversified through S&P or sector ETFs and total stock market. So I know how to diversify myself so that I don't get in a pickle. You never, in my opinion, guys, and I'm not your financial advisor, and I'm not trying to tell you what to do, but I don't think you ever should concentrate all your money into 1 or 2 or 3 or 4 or 5 little stocks. I just wouldn't do that. Just not enough diversification for me. I'd rather have the top 500 companies. Even though I've already told you the top 500 companies, only 7 of them are really pulling the weight, right? So you got to understand that. There's only 7 pulling the weight, but I still like the top 500, right? Only 7 are really pulling the weight. So take that for what it's worth. Well, guys, I appreciate you. I don't believe there'll be a crash in the market. And I've told you why. I only believe that things happen in the markets that represent a decline in value, not a crash. A crash, in my opinion, you never come back. There is no rebound in a crash. It's done. You're kaput. I think what happens in these markets are sometimes you do have a decline in value. I think we experienced that in 2020, in March of 2020 when the pandemic broke out. Remember, we had that 35% decline in value in the stock market. But guess what it did 57 days later? All-time highs. Oh, it's a crash. We'll never recover. It'll never be the same. That's what they were pumping out in the propaganda machine on the media, right? That's what they were pumping out. We'll never be the same. It'll never return again. Oh my goodness, this is the worst crash since everything. This is the worst crash since 1932. 57 days later, all-time highs. So you got to be careful with this propaganda, man. I keep telling you, be careful with it. The 1% are pretty tricky. They control the financial markets. They control our economy. And anything they can do to 3-card Monte you, they're going to try to 3-card money you, right? They're going to try to do the old shell game on you. So you got to be careful, man. They got really quick sleight of hand. That 3-card Monte, they're going to try to run it on you. Don't let them fool you. Don't let them fool you. Don't play their game. You get your game plan together, you get the assets you want to buy, and you keep buying them till you reach your goal. That's what you got to do if you want to build wealth. That's what you got to do. Well, guys, thank you so much for tapping in. Hit that like button on your way out of the live, man, out of the video, please. Looks like we got some people in live. Hit that like button for me, please. Hit it before you leave. If you appreciate the content, please hit that like button. Also, do me a big favor. Share this content. Share it with somebody in your network, right? Somebody that could use some of this financial information. Share it with them. Share the video, man. Send it out to them. Do me that favor. Send this content out to somebody. Just send them the link and say, hey, watch this. It might help somebody, right? It may help somebody get to their financial freedom, guys. That's all I'm saying. Let's help one another get to our financial freedom, right? Let's not be selfish. Let's spread the word. Let's help as many people as we can get to their freedom. Guess what? We help enough people get what they want. We typically get what we want, right? People first, money second, right? People first, money second. People first, money second. So please share this content. Hit that like button as well on your way out. I really, really would appreciate it, guys. Hopefully you got something out of this message today. If you did, drop me a comment and let me know you got something out of this message. I really would appreciate it. If you want them 12 free stocks from Webull, guys, click on that link down in the description box. There's a link down in the description box for that Webull offer. They're going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out the brokerage app. There's a link down in the description box. Go tap on that link, open up your account, fund it, go get that free stock, go get that free money. And if you want a Webull tutorial video to walk you through how to use the Webull app, just send me a DM on Instagram at RichardFane28. Let me know you've opened the Webull account. Let me know you funded it. And I'm gonna send you that Webull tutorial video. It's gonna walk you through how to use the app to make your first trade. And then you're on your way to building wealth, man. And then you just gotta get your game plan together and just follow that game plan, right? Follow that game plan. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm gonna catch you on the next live or on the next video. Peace out.